So this morning we saw the announcement from Bank of Canada with regards to their monetary policy review, and they announced that the rates are going to stay at 5%. Okay, they didn't change anything with regards to rates, and this was pretty much expected from the wider economist community and the financial media. So there are no surprises here. But one thing that I noticed was their tone was very dovish. And what I mean by that is, in the previous monetary policy review meetings, their tone had been very hawkish. So they used to tell us that, hey, we will keep the doors open for future rate hikes, and we will be data dependent when it comes to deciding about future rate hikes. That tone was not there today. Okay, that was a big difference. And if we look into the PDF, the monetary policy report, which is around 50 to 60 pages long, we noticed that they talked about all the parameters that we discuss on this channel, like population growth, that is driving the rental inflation. They also talked about the real GDP that has been negative in Canada for quite some time, and it is going to stay negative because the projections are not good either. They talked about the slowdown in the global economy as well. So we saw China slowing down, we saw Eurozone struggling. US has been somewhat unique because their economy is quite resilient so far. Canada is feeling the pinch in terms of the slowdown, right? So we saw the retail sales number were quite slow for the month of December and November. We saw the job numbers were horrible, right? 100 jobs created compared to 15,000 estimated number. And at the same time, we imported 15,000 people in this country. Mind you, the rental demand that has been directly fueled by the immigration has very less dependency on the rate hikes. And the reason is the rental demand is supply and demand equation, simple. When you import 2 million people in this country, they need houses to live, to stay. That is not driven by the interest rate, okay? Versus the house prices, which is a direct function of the rate, increases or decreases. So they talked about all of that. But the most important thing that I noticed in this report is the CPI projections. So as per their own projections, they are seeing the CPI is coming down to 2.1% in 2025. So even in 2025, seeing inflation coming down sub 2%. That is their ultimate goal. Even though they say 2 to 3% is okay, but their goal had been since the beginning was to bring it down under 2%. And that's not even happening until 2025. So that the projection has been revised constantly, right? So we saw it was supposed to be done in 2023, didn't happen. It was supposed to be done in 2024, doesn't look like it's going to happen. And now their projection is telling us it's going to be in 2025. And that could also change because it's all projection. Things can also change based upon the other factors like geopolitical situation, the crisis in the Red Sea that could easily ignite the inflation back up again. Because if the oil prices go up, if the shipping charges are going to go up because the shipping route has been disturbed, that is all inflationary. This dovish tone is also kind of interesting based upon their narrative. I think we all can agree that they're done with the rate hikes. I think there are no more rate hikes coming, at least in the near future. But they did not specifically call out the rate cuts when and how they're going to do that. What I noticed was they sent their narrative out in a way that they are pushing the market to front run that. Okay, so with this dovish tone, they're expecting the market to price in the rate cuts and front run that before they actually cut the rates. Okay, what I think is going to happen is, especially in the housing market, we are approaching the spring market. I think with this narrative, it can push the housing market a little bit. Okay, not too much, just a little bit. I see some activity is going to happen because the narrative is dovish. The sentiment is going to be a little bit different in the market because now people will expect rate hikes to happen anytime soon. So the market will try to front run that. Okay, could be wrong. This is just my thesis based upon what I see from the report and their tone from the communication perspective, that could happen. I've already started seeing some activity in the housing market. It could be short-lived, right? Because at the end of the day, the economic situation is deteriorating, the labor market is getting deteriorated. So if people start losing jobs or their purchasing power getting eroded, the housing market will see that impact. Overall, I think the economic situation is not good. They're admitting it. And the thing, as I said previously, that any economic crisis, any severe recession will force them to cut rates. But until then, they will try to keep it at this level because the impact, the real impact of the rate cuts, still yet to be seen in full force in the economy. Anyway, this is just my thoughts I'm sharing with you. If you have any questions or comments, put your comments down below. Let me know what you think about that. If you like this video, give me a thumbs up, subscribe, and I'll see you in my next video.